When most people think about investing, what comes to mind? Probably being super smart, right? Spotting the next big thing, predicting the next crash, or just moving lightning fast when the news breaks. Well, Benjamin Graham had a completely different idea. He said, look, investing isn't about being brilliant. It's about being disciplined, patient, and emotionally stable when pretty much everyone else is losing their minds. And that's exactly why the intelligent investor is still so relevant, decades later. Markets change, technology definitely changes, but human behavior, that doesn't. So, in this explainer, we're going to break down the core ideas that really make someone an intelligent investor, and we'll also pull in some modern context from Jason Zweig, whose commentary is fantastic for translating Graham's principles into the world we live in today. And hey, if you walk away with just one thing, let it be this. The goal is not to get rich quickly. The goal is to avoid getting poor. We're going to cover 5 key ideas today, and we'll start with what is probably Graham's most important distinction of all.
See, there are really only 2 ways people play in the stock market. One is investing. The other is speculating.
Speculating is when you buy something mostly because you think someone else is going to pay more for it, and soon. But investing, that's when you buy something because you genuinely believe the underlying business is worth more than the price you're paying, and you can back that up with real analysis. So the difference isn't the asset itself. The difference is your reason, your process, and your expectations. A stock can be a solid investment at one price and a total speculation at another. The exact same company can be a really sensible purchase when nobody cares about it, and a super dangerous bet when it's all over the news. Graham's point is so simple. If you can't explain why something is worth more than you paid for it, you're not investing. You're just hoping. And let's be real, hope is not a strategy, and it is definitely not a retirement plan. Okay, so this brings us to the big idea, the one that sits right at the very heart of this entire book, the margin of safety. What is it? Well, it's that protective gap, that essential buffer between the price you pay and the value you get. The classic way to really get your head around this is to think of it like a bridge. So if you need a bridge to hold a 10-ton truck, you don't build it to handle exactly 10 tons, right? No way. You build it to handle 30 tons. Why? Because you can't predict the future. Valuing a business is really hard. You're trying to estimate decades of future cash flows. Your brilliant analysis could be wrong. The economy could take a nosedive. A great company can hit a really rough patch. So instead of pretending you have a crystal ball, you build a buffer. You only buy when the price is meaningfully below what you conservatively believe the business is worth. That gap is your margin of safety. And Graham is crystal clear on this. Without one, there's no such thing as intelligent investing. You're just rolling the dice and hoping the markets taste kind. Now, if the margin of safety is the foundation of your investment house, then emotional control, well, that's the walls and the roof. And Graham teaches this with one of the most famous metaphors in all of finance, Mr. Market. Okay, imagine you own a little piece of a private business, and every single day, your business partner, this guy named Mr. Market, shows up. He offers to either buy your share from you or sell you his. Some days, he's totally euphoric. He thinks the business is the best thing since sliced bread and offers you a ridiculously high price. But other days, he's depressed. He's absolutely convinced the business is doomed and offers to sell you his shares for just pennies on the dollar. So Mr. Market is emotional, he's inconsistent, and he's often completely irrational. But here's the key. You don't have to do business with him. You can just ignore him. You only act when his mood creates an opportunity for you. When he's panicking and prices are low, maybe you buy. When he's euphoric and prices are through the roof, maybe you sell, or you just do nothing at all. The big mistake most people make is they treat Mr. Market like he's a guru. They think his price is a verdict on the business's real value. Graham says no. It's just a quote. It only tells you what someone else is willing to pay today, not what the business is actually worth. Jason Zweig's modern commentary on this just drives it home perfectly. Back in Graham's day, Mr. Market knocked on your door maybe once a day with the newspaper. But today, he's in your pocket, screaming at you every single second. Prices flash, alerts buzz, opinions are shouting from every screen. The emotional noise is just nonstop. And this means that for the modern intelligent investor, one of the most valuable skills isn't some complex analysis. It's the profound ability to simply sit still. So how do you actually apply all this? Well, Graham says first you need to know who you are. He splits investors into 2 types, the defensive and the enterprising. Now, this isn't about personality. It's about how much time, effort, and emotional energy you're truly willing to put in. The defensive investor wants a plan that's simple, resilient, and really hard to mess up. Their goal isn't to beat the market, it's to build wealth steadily and just avoid the big mistakes. For them, Graham recommends broad diversification and a consistent, disciplined approach. In today's world, that usually means a portfolio of low-cost index funds. So what about the other path? Well, the enterprising investor is willing to do the real work. They actually enjoy digging into financial statements and searching for specific companies that might be undervalued. But Graham gives a really stern warning here. Being enterprising does not mean being reckless. It demands even more discipline to research things thoroughly and still demand that margin of safety. You can work harder, but you can't skip to rules.
Now, let's talk about a trap that snares both types of investors: performance chasing. You see, our brains are basically wired backwards for markets. Most people buy after prices have already gone up because it feels safe, and they sell after prices have fallen because it feels scary and necessary. Graham says you have to completely flip this script. A market decline isn't a predator. It's often just Mr. Market having a bad day and offering you a sale. And this reframes the entire idea of risk. To most people, risk is volatility, the ups and downs of the market. But to Graham, real risk is the chance of a permanent loss of your capital. And that happens when you overpay for something, you're not diversified, or you panic and are forced to sell at the absolute worst possible time. The intelligent investor's main job is just to avoid these disastrous situations. So how do you defend against that risk? With systems. Graham was a huge fan of having a policy portfolio, a set mix of stocks and bonds that you rebalance every so often. And this is genius because it automates good behavior. When stocks have had a great run, you automatically sell some to get back to your target, locking in profits. When stocks crash, you automatically buy some, picking up assets when they're on sale. It's a system designed to make you buy low and sell high, turning discipline into a habit. Because systems beat moods every single time. So let's make this really concrete. How do you actually put these principles into practice? Here's a 6-step action plan, all based on Graham's philosophy. Number 1, decide which game you're playing, defensive or enterprising, and be brutally honest with yourself about the time and effort you really have. 2, create your rules before emotions hit. For example, I will invest X dollars every month, and I will rebalance my 60-40 portfolio every June no matter what. Write it down. A written rule ends the negotiation with your future panicked self. 3, separate price from value. Don't just assume a rising stock is a better business or a falling stock is a worse one. Earn that conclusion through analysis, not market vibes. 4, always demand a margin of safety. Avoid paying these heroic prices for any asset that require a perfect future just to work out. 5, diversify. It's the ultimate admission that you don't know the future. It's not going to guarantee profits, but it is your absolute best defense against disaster. And 6, ignore Mr. Market's mood swings. Use him for quotes, not guidance. And as Jason Zweig adds, the best way to do this today is to simply check your portfolio less often. Better behavior leads to better results. Ultimately, being an intelligent investor is a mindset. I know it looks boring from the outside. It looks like a lot of waiting, a lot of reading, and just sticking to a plan. But boring is the whole point. Because over the long run, the market punishes excitement and rewards endurance. So let's land this with the core message. Your job as an investor is not to predict the future. It is to prepare for it, to build a plan so resilient that it can survive crashes, bubbles, recessions, and most importantly, your own human emotions. That is what makes you an intelligent investor. And that is how you make the market work for you instead of the other way around.